Hello everyone, my name is Yogesh Bhandari. In this presentation, we are going to analyze the new income tax returns notified for assessment year 2020-21. We will go through the income tax form to be used by a taxpayer to file the income tax return for assessment year 2020-21. For an individual, ITR 1 shall be utilized by an individual who is having income from salary or pension for ordinarily resident person, who is having income or losses from one house property, excluding brought forward losses and losses to be carried forward, who is having income from family pension for ordinarily resident person, who is having income from other sources other than income chargeable to tax at special rate, including winnings from lottery and race horses or losses under this head. ITR 1 can be filed by an individual only who is ordinarily resident in India. ITR 1 cannot be filed if agricultural income exceed Rs 5,000, if total income is exceeding Rs 50 lakhs, if the SSC has any brought forward losses or losses to be carried forward under any heads of income, if SSC has income from foreign sources or foreign assets including financial interest in any foreign entity or signing authority in any account outside India. ITR 2 shall be utilized by an individual who is having income from following sources: salary income, whether from a resident or non-resident person, or such salary is earned by any individual who is a director in any company; income from house property without any restriction on the number of house property or brought forward losses; income from capital gains; income from other sources. ITR 3 shall be utilized by an individual who is having income from following sources: salary income, whether from a resident or non-resident person, or such salary is earned by any individual who is a director in any company; income from house property without any restriction on number of house property and brought forward losses; income from business or profession. This is the new thing in ITR 3. Income from capital gains, income from other sources. ITR 4 shall be utilized by an individual who is having income from following sources: income from salary or pension for ordinarily resident person, income or loss from one house property, excluding brought forward losses and losses to be carried forward, income from presumptive business or profession covered under section 44AD, 44ADA and 44AE for person resident in India, family pension for ordinarily resident person, income from other sources. Income chargeable to tax at special rates is not covered, including winning from lottery and race horses or loss under this head. ITR 4 can be filed only by an individual or HUF who is ordinarily resident in India and by a firm other than LLP resident in India. ITR 4 cannot be filed if agricultural income exceeding Rs 5,000, total income exceeding Rs 50 lakhs, SSC has any brought forward losses or losses to be carried forward under any head of income, SSC has income from foreign sources, foreign assets including financial interest in any foreign entity, or signing authority in any account outside India. Let us understand which income tax form can be used by SSC other than individual. ITR 4 can be utilized by firm excluding LLPs opting for presumptive taxation scheme of Section 44AD, Section 44ADA or Section 44AE. ITR 5 can be utilized by firm, including LLPs, association of persons, body of individuals, local authority, artificial judicial person. ITR 6 can be utilized by companies other than companies claiming exemption under Section 11. ITR 7 can be utilized by persons, including companies required to furnish return under Section 139(4)(a), Section 139(4)(b), Section 139(4)(c), and Section 139(4)(d). Let us see what is given in Schedule DI of the notified income tax return. As exceptional circumstances due to COVID-19 pandemic has arisen for the first time, the existing ITR forms had no option to allow the deductions if investments are made by the taxpayer after the end of financial year. Thus, a new Schedule DI has been inserted in the ITR forms to allow taxpayer to avail the deduction for the investment or deposits made during the extended period. Schedule DI is bifurcated into following 3 points. Part A. It seeks details of the investment, deposit, or payments made to claim deduction under Chapter 6A. Part B seeks details of eligible amount of deductions available under Section 10AA. And Part C seeks details of payment, acquisition, purchase, or construction made to claim deduction under Section 54 to 54GB. It must be noted that though the timeline for making investment has been extended by 3 months, but there is no increase in the threshold limit available under respective sections. Example, if a taxpayer is claiming deduction under Section 80C, the aggregate amount of deduction for investment or payment made during the period of 1st April 2019 to 31st March 2020 and 1st April 2020 to 30th June 2020 shall not exceed Rs 1,50,000. Additional details to be furnished by a person who is filing return under the 7th proviso to Section 139(1). To ensure that individuals entering into certain high-value transactions furnish the income tax return, the 7th proviso to Section 139 was inserted by the Finance Act 2019. The provision requires every person who is otherwise not required to file the return due to the reasons that his income does not exceed the maximum exemption limit to file the return of income if during the previous year he has: Number 1. Deposited more than Rs 1 crore in one or more current account maintained with a bank or a cooperative bank. Number 2. Incurred more than Rs 2 lakhs for himself or any other person for travel to a foreign country. Number 3. Incurred more than Rs 1 lakh towards payment of electricity bill. If an assessee is required to file the return of income in the circumstances covered under the 7th proviso to Section 139(1), he is required to furnish the relevant details in ITR form, that is, amount deposited in the current account, the amount incurred on the foreign travel, or amount paid towards electricity bill. Option to code PAN or Aadhaar in various schedules. The Finance Act 2019 inserted subsection 5E to Section 139A to allow the interchangeability of Aadhaar with PAN. Thus, where a person has not been allotted PAN but he possesses the Aadhaar, he may furnish his Aadhaar number in lieu of PAN, and such person shall be allotted a PAN in the prescribed manner. Further, every person who has been allotted a PAN and who has linked his Aadhaar number with PAN as per Section 139AA may furnish his Aadhaar number in lieu of the PAN for all the transactions where quoting of PAN is mandatory as per Income Tax Act. Various schedules of ITR require the assessee to furnish the PAN of the second party, inter alia, tenant, director, auditor, etc. To allow quoting of Aadhaar in place of PAN, These schedules now substitute the term PAN with PAN or Aadhaar. Accordingly, the SSC can furnish Aadhaar or PAN in respect of the following person. A person filing the income tax return as a representative SSC. Auditor in a proprietorship firm or a partnership firm. Debtor in respect of whom bad debt of Rs 1 lakh or more is claimed. Co-owner of the house property. Tenant of the house property. Buyer of the immovable property transferred during the year. A person whose tax credit is being claimed by the SSC. Tenants or buyer who can deduct tax at source. Key person and person verifying the return of a company. Person holding 10% or more of the voting power in case of unlisted company. Shareholders of unlisted company including startup. Person whose income is clubbed with the income of the SSC. And spouse governed by Portuguese Civil Code. Reporting of cash receipt or payment where turnover of SSC is between Rs 1 crore to Rs 5 crores. Up to the assessment year 2019-20, every person carrying on business was required to get its books of accounts audited from a chartered accountant if its total sales, turnover or gross asset from a business exceed Rs 1 crore during the previous year. To reduce the compliance burden on the small and medium enterprises, the Finance Act 2020 has increased the threshold limit under Section 44AB for the mandatory audit. With effect from assessment year 2020-21, threshold limit for the mandatory audit for a person carrying on business is increased from Rs 1 crore to 5 crores. However, the increased threshold limit of Rs 5 crores shall be applicable only if cash receipts or cash payments during the year does not exceed 5% of the total receipt or payment, as the case may be. In other words, more than 95% of the business transaction should be done through banking channel. To incorporate the above amendments, the ITR forms have been amended requiring the SSC to tick the checkbox if cash receipt or cash payment exceeds 5%. If SSC ticks the radio button of yes, he will be liable to tax audit under Section 44AB. Schedule SH1 not applicable in case of Section 8 companies and companies limited by guarantee. If a closely held company, a company in which public is not substantially interested, issues shares at a price which is higher than its face value and fair market value, the difference between the fair market value and issue price is charged to tax in the hands of the company under the head Income from Other Sources. In common parlance, such tax is called angel tax. Startups are exempted from levy of angel tax if it satisfies the condition mentioned in BPIIT's notification. To keep a check on the issuance of shares by such companies, the ITR 6 requires every unlisted company to provide information about their shareholders and the price at which shares are issued to them. The details are required to be provided in Schedule SH1 by the unlisted companies not being a startup. Startups are required to provide details in Schedule SH2. In new form, it has been clarified that SH1 is not applicable in case of a company that is registered under Section 8 of the Companies Act 2013 or Section 25 of the Companies Act 1956, or a company limited by guarantee under Section 3(2) of the Companies Act 2013. A depreciation rate of 45% added in the block of plant and machinery. Up to the assessment year 2019-2020, three blocks were available to calculate depreciation on the plant and machinery, that is 15%, 30% and 40%. To boost the demand for motor vehicles, the Finance Minister announced an additional depreciation of 15% on motor vehicle purchased between 23rd August 2019 to 31st March 2020. This announcement was made on 23rd August 2019 as a part of stimulus package. The new depreciation rates were notified by CBDT on 20th September 2019 with retrospective effect from 23rd August 2019. As there is no 45% existing rate of depreciation, the relevant columns and depreciation schedule have been notified to allow computation of depreciation at the rate of 45%. Reporting of residuary income which is chargeable to tax as per double taxation avoidance agreement. There are certain incomes like interest which are chargeable to tax in the hands of the SSE as per the applicable rates specified in Income Tax Act 1961. However, the same income may be chargeable to tax at a concessional rate as per double taxation avoidance agreement. Section 90 of the Income Tax Act allows an SSE to opt for the provision of Income Tax Act or of DTAA, whichever is more beneficial to him. Therefore, an SSE would certainly avail the benefit of DTAA if tax rate provided therein is lower than the tax rate provided under the Act. Thus, to allow such option, Schedule OS provides an option to the SSE to separately report such income which is chargeable to tax at special rates as per double taxation avoidance agreement. Consequential changes in the schedule of deductions under Chapter 6A. Deductions under Section 80 EEA and 80 EEB. Section 80 EEA and Section 80 EEB were introduced by Finance Act 2019 to provide deductions in respect of interest on housing loan and interest on loan taken for electric vehicles respectively. The necessary changes have been made to the ITR forms to claim these deductions in the income tax returns. Deductions under Section 80 PA. Section 80 PA was introduced by Finance Act 2018 to provide a deduction to a producer company for entire profit and gains arising from its business. However, these deductions can be claimed for a period of 5 years starting from 2018 to 2019 to 2023-24. So, to facilitate the SSE company to claim deduction under Section 80 PA, new column has been inserted. SSE can choose multiple bank accounts for payment of refund. At the time of filing of income tax return, SSE is required to furnish the details of all bank accounts held in India during the previous year, excluding dormant accounts. Out of the mentioned account, SSE is required to indicate minimum one account in which he prefers to get the income tax refund. In the new income tax return form, the SSE has been given an option to choose multiple bank accounts for the payment of refund. However, the refund will be credited to one of the account decided by CPC after processing of the income tax return. Companies opting for Section 115 BAA and 115 BAB. Section 115 BAA and Section 115 BAB were introduced by the Taxation Law Amendment Act 2019 to provide special tax regimes for various specified domestic companies, also known as alternate tax regimes. There are some disallowances under the alternate tax regimes. Thus, in Part A of General Schedules, the company is required to choose whether it is opting for any of the alternative tax regimes of Section 115 BA, 115 BAA, or 115 BAB. Trust to furnish details of re-registration made under the new provisions. The Finance Act 2020 has introduced major changes in the provisions applicable to the NGOs by introducing new Section 12AB replacing Section 12AA and bringing in similar amendment in Section 1023C and Section 80G. These changes were originally effective from 1st June 2020. However, due to the unprecedented economic crisis, the government issued a press release on 9th May 2020 to defer the implementation of new procedure for approval registration. It is to be noted that the trusts or institutions which have been granted perpetuity of registration under Section 12A or 12AA or approval under Section 1023C or Section 80G are required to make an application again under the new Section 12AB or amended provisions of Section 1023C or Section 80G within 3 months from 1st October 2020, that is by 31st December 2020. The new Form ITR 7 requires the SSC to furnish the following details in respect of the application for registration made under new provisions. Whether application for registration is made as per new provisions, section under which registration is applied, date on which application for registration or approval as per new provision is made, relevant section for claiming exemption under the new provisions. As per the amended provisions, the registration under Section 12AA shall become inoperative if approval is obtained under Section 1023C or the institution is notified under Section 1046. Hence, an entity has an option to claim exemption either under Section 1023C or Section 11. Therefore, the new ITR form also seeks the section of exemption opted for under the new provisions. The Finance Minister, in the press conference, announced the extension of the due date of all income tax return for the financial year 2019-20 from July 31st, 2020 and October 31st, 2020 to November 30th, 2020. Interestingly, the requirement to file an application by NGOs has already been deferred to 1st October 2020, hence the application can be filed by 31st December 2020. Therefore, these details asked in new Form ITR 7 shall be filled only if application for registration under new provisions has been filed before the filing of income tax return. Separate reporting to be made of interest payable on loan taken from a deposit taking NBFC or systematically important NBFC. With effect from assessment year 2020-21, Section 43B has been amended by the Finance Act 2019 to provide that any interest payable on any loan or borrowings from a deposit taking NBFC or systematically important non-deposit taking NBFC would be allowed as a deduction only on actual payment. Consequential amendment has been made to ITR 5 and ITR 6 to require a separate reporting of the same. Separate reporting is required for income from life insurance business. Up to the assessment year 2019-20, no separate computation of income from the life insurance business, as referred to under Section 115D, was required under Schedule BP, that is, computation of income from business or profession. The new ITR Form 5 and 6, introduced for the assessment year 2020-21, require a separate reporting of income from life insurance business in Schedule BP. It requires the following information in this respect: net profit or loss from insurance business referred to in Section 115B. Addition in accordance with Section 30 to Section 43B. Deductions in accordance with Section 30 to Section 43B. And income from life insurance business under Section 115B. Similar changes have been made in other schedules. Inter alia, separate information is required for income from life insurance business in the schedule. Details of losses to be carried forward to future years. Details of the authorized person verifying the ITR of company to be furnished. Up to the assessment year 2019-20, the return of a company could be signed and verified by its managing director. However, if for any unavoidable reason the managing director is not able to verify the return, or where there is no managing director, the return may be verified by any director of the company. The Finance Act 2020 has amended Section 40 with effect from the assessment year 2020-21 to enable any person, as may be prescribed by the board, to verify the return of income of a company. Accordingly, the new ITR 6 incorporates the reference of eligible person who is verifying the return in the schedule of key persons. Following details are required in respect of such person: name, designation, residential address, PAN, Aadhaar number, director identification number issued by MCA in case of a director. Such reference has been inserted to ensure that the return has been verified by the eligible person only. Option to choose self-occupied property introduced in ITR 5 and ITR 6. While furnishing the information in Schedule HP, details of income from house property, an assessee needs to furnish the nature of house property. Up to assessment year 2019-20, 3 options were available for selection in Form ITR 1 to ITR 4, that is, self-occupied, let out, and deemed let out. Whereas ITR 5 and ITR 6 contained only 2 options, that is, let out and deemed let out. As per Section 23(5) of the Income Tax Act, where the property consisting of any building or land appertaining thereto is held as stock in trade, and the property or any part of the property is not let out during the whole or any part of the previous year, the annual value of such property or part of the property for the period up to 2 years from the end of the financial year in which the certificate of completion of the construction of the property is obtained from the competent authority shall be taken to be nil. Considering the provision of Section 23(5), where annual value of the property is taken as nil, the ITR Form 5 and 6 for assessment year 2020-21 allows selection of self-occupied house property in Schedule HP. Thus, an assessee filing return in ITR 5 or ITR 6 can also enter the details of self-occupied property as well. Reporting of share in co-owned land and building. Any capital gain or loss arising from the sale of land or building or both is required to be reported by an assessee in Schedule CG of the ITR form. In the new ITR 6, a company is now required to report its share in land or building in case of co-ownership. Type of company to be reported: if the assessee is a director in a company or holding unlisted equity shares. ITR forms applicable for assessment year 2019-20 required the directors of the company to furnish the following details: name of the company, PAN, whether the shares are listed or not, director identification number, DIN. The initiative was taken to check the shell companies and the ghost directors. The new ITR forms for the assessment year 2020-21 require the directors to provide information regarding the type of the companies. The utility will provide a drop-down list of the type of companies, and the SSE director is required to choose any one from them. Zip code required at some additional places under Schedule FA. Zip codes are commonly known as PIN code in India. These codes are the postal codes assigned to various areas. In the new notified forms, the SSE is required to furnish the zip codes in Schedule FA in respect of various fixed assets owned by the SSE. The requirement is introduced to get more information regarding the assets of the SSE. While furnishing the details in any of the following cases, the requirement to furnish zip codes has been introduced in the latest notified forms. Details of financial interest in any entity held, including any beneficial interest, at any time during the relevant accounting period. Details of immovable property held, including any beneficial interest, at any time during the relevant accounting period. Details of any other capital asset held, including any beneficial interest, at any time during the relevant accounting period. Details of accounts in which SSE has signing authority, including any beneficial interest, at any time during the relevant accounting period, and which has not been included in any of the other in the schedule. Details of trusts created under the law of the country outside India, in which SSE is a trustee, beneficiary or settler, etc. Details of any other income derived from any source outside India which is not included in any of the other items of Schedule FA or income under the head business or profession.